Well, good morning, everyone. Welcome, and thank you all for coming. I've already had the pleasure earlier of meeting a good many of you, but for those who haven't met me, I'm Conrad Tan. I'm an ESG analyst at Bloomberg Intelligence, and today I'm going to take you through a few key ESG risks that we see emerging globally across different industries. And if there's one key takeaway from my presentation today, it's that despite political tensions and the very real pressure on ESG that we're seeing, there are still many multilateral efforts in progress to fight climate change, which is of course a good thing, but it does mean that many companies and industries face intensifying transition risks in parallel with the physical risks from climate change that we all experience today. Briefly on Bloomberg Intelligence, or BI, we are an independent research platform of Bloomberg with around 500 research professionals worldwide, covering all major asset classes across through different lenses, including, of course, ESG. Within ESG, we are a global team. I'm based here in Singapore, and we also have analysts in Tokyo, London, and New York. Now, we spend much of our time helping investors to understand how different ESG risks affect different industries, including potential channels of financial impact, and ultimately which ESG issues are most material for each industry. So, taking the carbon transition as an example, this is today one of the most discussed ESG risks, understandably so, and yet our understanding of how it impacts different industries continues to evolve very rapidly. So at Bloomberg Intelligence, we track the world's top emitting companies globally across different industries in order to assess both the level of ambition as well as the credibility of their decarbonization targets and ultimately the progress that they're making year by year towards those targets. This gives us insight into which companies and industries are leading or falling behind. This may seem less important in today's political climate, but it matters because emissions regulations that are already in place are becoming stricter by design, which exposes many companies and industries that are lagging to increasingly greater financial penalties, as we'll see shortly. Now, one of the key insights from our analysis is that many industries will have to rely on carbon offsets to get to and stay on a science-based decarbonization pathway. This adds a new dimension to the transition risks that companies face, because companies now have to face a complex regulatory and policy landscape for carbon offsets and potentially a market-based carbon price that is volatile. A good example of this is the airline industry. So, starting October this year, almost all airlines globally will have to start recognizing charges for carbon emissions for the first time. Why October? This is when the UN ICAO agency publishes something called the Sector Growth Factor, which measures the growth in international aviation emissions versus the pre-pandemic baseline. And this is going to turn positive this year in respect of 2024 emissions. The only uncertainty is how high it's going to be. This means that airlines now face a new financial risk. Now, big airlines have already started to try to limit the emissions growth by using or switching to cleaner fuel. But as some of you will know, there simply isn't enough of it. So globally, the supply of sustainable aviation fuel in 2024 was less than 0.5% of total conventional jet fuel. What is available is also expensive, on average about 3 times the price of conventional jet fuel. So airlines are going to have to buy offsets for their excess emissions, and the future price of these offsets is a great source of uncertainty. Something similar is emerging in international shipping, which of course underpins global trade, supply chains, and distribution networks for many other industries. So from 2028, ships will have to use cleaner fuel or pay up to $380 per ton for excess emissions to meet decarbonization targets set by the International Maritime Organization. These draft rules were agreed in April and are set to be formally adopted in October. It's worth emphasizing again that both international aviation and shipping, and international aviation is not just airlines, by the way, it also applies to air freight, which means logistics companies that use air freight. Both of these underpin global supply chains and downstream distribution networks for a whole host of different industries. So costs here are likely to feed into multiple other industries as well. Another key risk that we see emerging that hasn't been adequately internalized in most industries is water scarcity. Our analysis shows that water is a financially material issue for close to half of the more than 100 industries globally that we analyzed. Of these, around half depend on water directly for production or development, and many others depend on it for things like cooling and extraction, and still others have to deal with wastewater disposal risks. In tech, for example, semiconductors and data centers are some of the most exposed industries to water scarcity risks. In critical infrastructure, our analysis shows that 1 in 5 operational power plants is likely to be in an area of high or extremely high water stress by 2030. This, of course, makes them more vulnerable to operational failures and also exposes the companies that own these power plants to much higher financial costs in order to harden the infrastructure. These insights and a lot more are available in a deep dive report that we published on water risks earlier this year. You can read it on any Bloomberg terminal, or feel free to get in touch with any of us if you're keen. Now, to better understand the market impact of different ESG risks, we've developed an app that allows us to analyze industry-specific ESG events such as product recalls, labor disputes, or oil spills, and to look at the impact on companies' share prices as well as credit spreads over different time horizons. We're able to do this by drawing on the vast library of extremely high-quality content produced by our terrific colleagues from Bloomberg News. And this gives us insight into what the market reaction is to different kinds of ESG events. So for example, if we take the packaged food industry, one of the findings we had was that ESG events that hurt a company's reputation, for example, allegations of abuse in the labor workforce or in the supply chains, tend to result in more persistent underperformance versus operational disruptions from ESG events such as strikes that produce sharper but also shorter-lived price movements. Basically, the market differentiates between operational ESG disruptions that are seen as resolvable relatively quickly, even things like product recalls, versus issues such as supply chain abuses that raise questions and longer-term concerns around governance and risk management that ultimately impact valuation. We also look at what ESG issues impact company share prices the most at the industry level. To do this, we draw on our Bloomberg ESG scores that measure companies' ESG performance on an individual issue level. We're then able to analyze this in detail and look at what the impact is on share prices for better performing companies versus worse performing companies. So in the example here, We see that in metals and mining, share price or share return outperformance is more strongly linked with performance on workplace health and safety, which makes sense if you think about it, because metals and mining is a dangerous business. So if a company is having multiple accidents in the workplace consistently, that tends to indicate structural issues in the way that the company is managing operational risk. And over time, this translates into potential regulatory penalties, or in extreme cases, even withdrawal of mining concessions. Moving on to climate, we now track climate damages across different regions globally, and we're continuing to expand this data set to add more detail. Now, this gives us insight, among other things, into this gives us insight into the strain that damages from climate-related disasters is having on public finances, which is of great interest to bond investors because ultimately it affects the issuer's ability to repay. This is especially important in, for example, the US municipal bond market, where local governments don't have the ability just to print money. It also gives us an idea of the risk exposures of insurers and reinsurers who may be exposed to rising claims. As with water, the risks vary across different industries, and industries like utilities, power plants tend to be more exposed than others. Those insights are also available in a separate deep dive report that our team has published early this year. Again, you can read it on the terminal. You can get in touch with us if you're interested. While the focus has been rightly on environmental issues such as climate, I do want to highlight data security and privacy as a key emerging risk that we see. This is very poorly understood as a financially material risk across most industries. It's often seen as a technological issue. So companies that aren't focused on technology often don't develop the expertise to manage it properly. It tends to manifest itself in different ways. There are multiple channels of financial impact, which is why some of the biggest companies now take out cyber insurance, although the level of adoption remains very low, and especially so among smaller companies. I will add that the spread of artificial intelligence tools is a major source of new risk for data security and privacy, particularly in the ability of very precisely targeted social engineering attacks against senior executives of companies, many of whom are here today. And I think most companies really aren't prepared for this. So on that hopeful note, I will summarize. Basically, there are many ESG risks still emerging across different industries. Some are due to emissions regulations becoming stricter by design, as we saw. Others, such as water risks and data security and privacy risks, because they haven't really received adequate attention prior to this. And all of these risks don't affect different industries equally, which is why it's critical to understand how these exposures vary and the channels of financial impact for each industry. We do, as a team, discuss key ESG topics with industry experts on a weekly podcast that we host. For example, in a couple of weeks, I'll be discussing the implications of the new International Maritime Organization rules on decarbonizing shipping with one of our guests. So if you're interested, feel free to have a listen. I promise you our team is usually more upbeat on this podcast than what you just heard. With that, I thank you very much, and I hope you have a great conference ahead. Thank you.